Welcome to the Cardinal Commentary for the Canadian Equity Portfolios. The quarter had barely started when CP Rail merged with Kansas City Southern Railway, which it purchased in 2021 for $31 billion US. The newly named CPKC is the first and only railway to serve Canada, the US, and Mexico. To get an idea of its potential, here's CP's original network covering Canada and part of the Midwest and Northeastern US. And here's the CPKC network. The company believes it will be able to capture more rail market share and divert more trucks off the highway. If that happens, it projects $5 billion in revenue growth through 2028. We are confident that the merger represents a new era of transportation for freight across North America. CP's share price has more than doubled in the last 4 years, and we believe that the newly merged railway is poised for continued outperformance. The Bank of Canada, meanwhile, has been raising interest rates at a record pace for more than a year, bringing its overnight rate up to 5% in July. There's no question that it's working, as inflation rang in at 2.8% in June, the lowest level in 2 years. Here's portfolio manager Sheila Wilson-Cole.
We've seen inflation steadily decline over the past 6 to 9 months, which is certainly positive to see. A lot of that is goods inflation coming off, transportation is declining, commodities are declining as well. So we still see the housing having a fairly significant impact on inflation at this point in time, but it's certainly good to see that inflation is coming back down into that 2 to 3% range, which is better for the economy overall. And that means that central banks are closer to the point where they can stop raising rates and then eventually start to cut them.
Much of the falling consumer price index is due to gas prices, which are more than 21% lower than a year ago. We believe it won't be long before the Bank of Canada starts to lower interest rates. Again, here's Wilson-Cole.
The market to start the year was actually thinking we would see a cut towards the end of 2023. At this point in time, it's looking more likely that we won't see that until 2024. But again, it goes back to how is the economy faring? What does the employment picture look like? And those are things that are really changing month to month and quarter to quarter.
We recently welcomed Brookfield Corp to our Canadian portfolios. The Toronto-based company is one of the world's largest alternative investment managers. Its niche is direct control investments in real estate, renewable power, infrastructure, credit, and private equity. Some of you might remember it as Brascan, its late 20th century handle. Here's portfolio manager Evan Manser on the new addition.
Brookfield's always been attractive to us. We've always had our eye on it. Bruce Flatt has often been called the Warren Buffett of Canada. They've got a great investment team, a well-respected company. It's often expensive and trades at a premium, and its component companies tend to trade at a premium too. Recently, that price has come down a bit, maybe partially because of these interest rate increases, and we jumped on the opportunity to buy it. We think a lot of great trends are working for Brookfield. They've got some great assets, obviously, with renewables and with infrastructure, but then the core of the business, the Brookfield asset management side, we've noticed a real trend in our business in the investment industry where institutions are gravitating towards these real asset investments. And in the entire world of investing, Brookfield would be, arguably the number one company with that offering. And so we think the future is really bright for them.
We purchased Brookfield with the proceeds from the sale of Alimentation Couche-Tard, a Quebec-based company that we continue to believe is a high-quality convenience store and fuel retailer. Here's Manser again on the tough decision to sell Couche-Tard.
We sold Couche-Tard with a heavy heart because we have a lot of respect for the management team there, for their growth by acquisition strategy in the gas station and convenience store business. They are the global leader in that. Our concern has been on fuel margins. So there's the oil price, there's the refining, and then there's just the markup that gas stations are able to charge. And that's been at historic highs, more than double what the average has been over time. And so our concern has been that if that that margin reverts back to the mean, which there's probably a good chance it does, that might hurt Couche-Tard shares. If that were to occur and we were able to get back in at a little more reasonable price, you could see it in the portfolio again.
Our strategy of investing in industry-leading, dividend-paying companies continues to pay off. Over the last decade, the annual dividend income on a $1 million investment has grown from about $36,000 to more than $80,000. 8 of our companies raised their dividends in the quarter, led by TELUS at 3.6%, Sun Life Financial at 4.2%, and National Bank at 5.2%. 4 other banks and Pembina Pipeline also raised their dividends. It's been a challenging first 6 months of the year in the markets, but our Canadian portfolios continue to outperform when it really matters, like over 15 and 25 years. And here's the proof. If you had invested $500,000 in this portfolio in 1993, it would be worth more than $12.4 million today, more than double the benchmark. And why do we do all this? Because it works. And that's the cardinal commentary for the Canadian equity portfolios. Thanks for joining us.